Welcome to Aviation Intelligence Weekly with Sarah and Mike, your guide to the aviation industry. Welcome to Aviation Intelligence Weekly. I'm Sarah, and this is our earnings analysis for Sun Country Airlines, ticker SNCY, covering their Q1 2026 10Q filing dated May 1st, 2026. With me is Mike, our industry analyst. Mike, we're looking at a company in the middle of a major strategic pivot and a pending merger. What's your core thesis here?
If we reduce this filing to one sentence, it's this. Sun Country is executing a high-stakes cargo expansion while simultaneously managing merger integration, creating a dual execution risk scenario with compressed margins and operational complexity. Based on this filing, Sun Country Airlines is operating in a structural reset phase. They're fundamentally rebalancing their business model away from passenger operations toward cargo services while navigating a merger that closes as early as May 13th, 2026.
That's a sharp take. Let's test that thesis against the numbers. What were the material changes versus their prior filing?
The most striking change is the revenue mix transformation. Total operating revenues increased just 4% to $338.4 million. But that masks dramatic segment divergence. Cargo revenue exploded 64% to $46.1 million. That's a $17.9 million increase. Meanwhile, passenger revenue actually declined $629,000 to $285.3 million. For context, cargo now represents 13.6% of total revenue versus 8.6% in the prior year quarter.
And what's driving that cargo surge?
Two factors management explicitly called out in the MD&A. First, they received two additional Boeing 737-800 cargo aircraft in Q1, bringing their Amazon fleet from 20 to 22 aircraft. Second, they benefited from contractual rate increases under their amended air transportation services agreement with Amazon. Management stated these aircraft are expected to be in service by the third quarter of 2026.
But there's a margin story here that's concerning, right?
Exactly. Here's the causality chain that should worry investors. If cargo expansion continues at this pace while margins compress, Sun Country transforms from a high-margin hybrid carrier into a capital-intensive logistics operator. The cargo segment swung to an operating loss of $5.3 million. That's a 17 percentage point margin decline year over year. Meanwhile, passenger operating margin dropped 3.9 percentage points. If this margin compression persists through the merger integration, the combined entity's profitability profile fundamentally changes.
Let's dig into what management is actually saying about these changes. What signals are you picking up from their commentary?
Management's tone is notably defensive about the operational challenges. In the MD&A, they explicitly state, "We've incurred material expenses related to the merger, which had an impact to earnings in the first quarter of 2026. They're essentially pre-explaining margin pressure, but here's what's more telling. They emphasize their agile peak demand scheduling strategy and diversified business model repeatedly, which reads like justification for the strategic pivot.
Any specific language that stood out?
Yes. Management said, "The increase in aircraft that we operate on behalf of Amazon will result in more resources being allocated to the cargo segment. This aligns with our strategy of long-term flexibility and supports our ability to mitigate the impact of cyclical, economic, and industry downturns on our business." That's management explicitly stating they're shifting resources away from passenger operations toward cargo. It's not temporary, it's strategic.
And on the cost side?
They're dealing with multiple cost pressures simultaneously. Management noted that certain of our operating costs have been further impacted by inflationary pressures, geopolitical events, supply chain issues, and other macroeconomic conditions. Specifically on fuel, they expect costs to remain elevated until supply disruptions are resolved. That's not exactly a near-term optimistic outlook.
Speaking of costs, let's examine the financial red flags. What's concerning you from a balance sheet perspective?
The leverage profile is the biggest red flag. Total debt sits at $306.9 million against $153.7 million in cash and equivalents. That's a 2.1 debt to cash ratio. For a small cap airline expanding rapidly into capital intensive cargo operations, that's tight. But here's the more immediate concern. They incurred $9.8 million in special items related to merger expenses in just Q1. If the merger timeline extends or faces regulatory delays, these costs compound quickly.
What about operational cash burn?
The filing shows they're managing working capital carefully, but the unit economics are deteriorating. Cost per available seat, mile, KSM pressures are mounting. Salaries, wages, and benefits jumped 12% or $11.3 million year over year due to contractual pay increases as a result of new collective bargaining agreements. That's structural cost inflation, not cyclical.
Here's the causality chain I'm modeling. If merger costs continue escalating while cargo margins remain negative and fuel costs stay elevated, Sun Country burns through their cash cushion faster than the cargo revenue ramp can offset. What breaks first?
Liquidity becomes the binding constraint. At current cash levels and burn rates, they have limited runway if the cargo expansion doesn't achieve profitability by Q4 2026. The merger with Allegiant provides an exit, but if that deal faces delays, the standalone liquidity profile becomes stressed.
Let's move to risk disclosures. Any new risks or escalated language in this filing?
The filing doesn't highlight new risk factors versus prior periods, but there's implicit execution risk embedded in their strategy. Management acknowledges that certain accounting estimates and assumptions used in the preparation of our condensed consolidated financial statements involve financial projections or depend on factors that are inherently uncertain. During periods of economic uncertainty, they may need to reevaluate these estimates and assumptions, potentially resulting in a material impact on the company's financial position.
That sounds like standard boilerplate language, though.
True, but the context matters. They're making these statements while simultaneously expanding cargo operations, integrating new aircraft, and managing merger costs. The operational complexity amplifies the impact of any estimate revisions. For a small cap carrier, margin for error is limited.
Fair point. Now, let's examine their liquidity and balance sheet stress in more detail. How tight is their financial position?
From a pure liquidity standpoint, $153.7 million in cash provides reasonable near-term runway, but the trajectory is concerning. They're burning cash on merger expenses, expanding cargo operations that are currently unprofitable, and facing structural cost inflation in labor. The $306.9 million in long-term debt creates fixed obligations that don't flex with operational performance.
What about their credit facilities or debt maturities?
The filing doesn't provide detailed maturity schedules, but for a carrier their size, debt service coverage becomes critical if operating margins continue compressing. The cargo expansion requires additional capital expenditures. They're taking delivery of aircraft and investing in operational infrastructure. That's cash outflow today for revenue that may not materialize until Q3 2026 or later.
So the balance sheet is essentially funding a strategic gamble on cargo profitability?
Exactly. And if cargo margins don't improve significantly, they're trading high margin passenger capacity for low margin or negative margin cargo operations. That's balance sheet deterioration disguised as revenue growth.
Let's break down the segment level performance. We touched on this earlier, but give me the detailed winner-loser analysis.
The cargo segment is simultaneously the biggest winner and biggest loser. Winner in terms of revenue growth, 64% increase to $46.1 million. But it's the loser operationally, swinging to a $5.3 million operating loss. That's a 17 percentage point margin decline. For context, cargo now generates 13.6% of revenue, but consumes disproportionate resources and management attention.
What about the passenger segments?
Scheduled passenger service shows resilience in pricing power. They achieved a 12% increase in total fare per passenger despite reducing capacity. Load factor improved 1.2 percentage points to 82.4%, which is solid for Q1 seasonality. Charter operations performed well, with revenue increasing 5% and revenue per block hour up 6%, driven by rate increases and fuel recovery mechanisms.
So, the core passenger business is actually performing reasonably well.
The unit economics suggest yes, but the strategic direction suggests management is de-emphasizing it. They reduced passenger capacity to focus on cargo growth. That's a conscious choice to trade proven profitability for unproven cargo margins. From a capital allocation perspective, that's questionable.
Finally, let's discuss what traders should monitor going forward and test our core thesis. What are the key metrics to watch?
3 critical metrics. First, cargo segment operating margins in Q2 and Q3. If they don't turn positive by Q4, the strategic pivot fails. Second, merger timeline. Any delays beyond May 13th compound integration costs and liquidity pressure. Third, fuel cost trends. Management expects costs to remain elevated until supply disruptions are resolved. So any geopolitical escalation hits margins immediately.
And what would prove our structural reset thesis wrong?
If cargo operating margins turn positive in Q2 while passenger margins stabilize above 15% and the merger closes on schedule, our thesis is wrong. Specifically, if cargo achieves break-even margins while maintaining the 64% revenue growth trajectory, Sun Country successfully executes the hybrid model expansion rather than cannibalizing passenger profitability.
Let's revisit our core thesis. Does the evidence support Sun Country operating in a structural reset phase?
The evidence strongly confirms it. Revenue mix is shifting dramatically, margins are compressing across segments, merger costs are mounting, and management is explicitly reallocating resources from passenger to cargo operations. This isn't cyclical optimization, it's fundamental business model transformation under financial pressure.
How should investors think about valuation here?
At current margins and with pending merger completion, this equity trades like a merger arbitrage play rather than an operating airline investment. The standalone operational trajectory suggests margin compression and execution risk that would typically warrant a discount to industry multiples.
That wraps our analysis of Sun Country Airlines Q1 2026 10Q filing. Remember, this analysis is for informational purposes only and should not be considered investment advice. I'm Sarah with Mike. Thanks for listening to Aviation Intelligence Weekly.
Thanks, Sarah. We'll be back next week with more earnings analysis from the aviation sector.